Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Surabhi Upadhyay, Pavitra Parekh. As always, it's the day after the budget and one day to go for the weekend, girls. But the volatility in the market continues, right? It's just been less than 2 hours of trade and we've already seen the Nifty swing close to about 200 points. That said, the last 1 hour has seen a bit of a flat line, at least on the markets. So currently, the Nifty is down 27 points, a minor knock of about 0.1, 0.2%. The Sensex holding up in the green, but today is the weekly options expiry. But the saga continues in the Adani Group stocks and big moves seen, mostly on the way down. Adani Ports down 5%, Enterprises is up 10%. Ambuja Cement is where you are seeing some buying coming through at the lower level. So Ambuja Cement is up close to about 6%, but the rest of the pack, Adani Green, Adani Wilmar, Transmission, Power, big cuts, lower circuit practically for many of the Adani Group names. But on the flip side, you've got buying in FMCG and IT. So ITC is at a fresh record high. For Britannia, the margins are almost at record high. The company reported margins of 19.5% yesterday. The all-time high margins for Britannia were 19.8%, so almost there. IT has seen buying. Remember, yesterday, Nasdaq gained close to about 2%. There is that rub-off impact that you can see on names like Infosys, HCL Tech. So all in all, so far it appears to be a bit quiet on the, at least on the index when it comes to the Nifty, Sensex, even the mid-cap index. But there's so much bubbling underneath that line, right?
Absolutely, Reema. Yeah, you said it. Hi, good morning to you and good morning to Pavitra as well. I think the market will take this with both hands because when we got the news last night about the FPO being pulled out, I mean, it was fairly anxious sort of next couple of hours to figure out if there's going to be broader collateral damage or not. That hasn't happened. I mean, it's contained in that group of stocks as of now. Yes, the banks are sulking a little more, but then, you know, that's because of other factors as well. There's a lot of chatter around whether they'll have to now really compete for deposits because some of the small saving schemes, particularly for senior citizens, and they've been made more attractive. So, you know, there could be several reasons you could ascribe to why the bank Nifty is where it is. But largely the market's holding up. Before I toss it to you, Pavitra, I just have to go back and look at ITC. And I was doing that even in closing bell yesterday. Yeah. I mean, it's just been such a star of this budget season, right? It was up 4-5% yesterday. And even today, look at it go, 5.5%, no problems whatsoever. In fact, in this year alone, ITC's winnings are now almost touching 14.5%. I mean, it's what? We're barely, 31, 32 days into the year. And this is coming on the back of a stupendous year for ITC. We all know that. So, yeah, that's the one stock that's really got my attention, at least this morning.
ITC was up more than 50% last year. So just to refresh everyone's mind, it's a 50% gain and now again 14-15%.
Oh, absolutely. And also, like you mentioned, the IT names, right? I mean, you saw, of course, Meta rally in after trade. And on the back of that, you have all of the IT stocks doing really well. I mean, not that they haven't been doing well in the past few weeks as well. The Nasdaq has been outperforming. So you're seeing that play out in the Indian IT names as well. In addition to the Adani group of stocks, you're seeing the banks which are under pressure, like Surabhi mentioned. You have Reliance, which is seeing some cuts. So that one will come up for you. Stocks like HDFC, the earnings are today. So that one is also seeing pretty steep cuts right now. So that's a stock that I would watch for. And then it is the entire insurance space, right, which continues to be under pressure. So take a look at an HDFC Life. Of course, we saw the kind of cuts that came through yesterday. Today, once again, HDFC Max Life, these are the ones which are seeing the biggest cuts. But there are a lot more in the insurance space because of the budget announcement. So actually, let's kickstart the show by talking about exactly that. The budget has continued with the government's agenda of plugging tax arbitrage options used by the ultra-rich. So it has proposed taxing payouts received from life insurance policies issued after April 2023. This is if the total life insurance premium of all policies combined paid in a year is over 5 lakh rupees. So Yash is really standing by with an explainer on this. Yash, we heard about the announcements that came through, but take us through what the impact could look like. And you've also been talking to some of the bigger companies. So what do they have to say on this?
Well, that's correct, Pavitra. So a budget spelt out not just one but two negatives for the insurance sector and particularly life insurance industry. The first one, as you spoke about, was taxing the income from large ticket life insurance savings products. As far as this tax is concerned, before I explain it, let me just put it out straight that ULIP and term products are excluded from this tax. It's the savings life insurance policies which will come under the ambit. Now, what the government has said is that they will tax the income from savings life insurance policies where the aggregate premium exceeds 5 lakh a year. Essentially, what this means is that if you are buying life insurance policies, multiple or single, and the annual payout of the premium exceeds 5 lakh, that's when the taxation will come in on the policy with which an individual breaches that limit of 5 lakh in a year. This will be explained better with an example. Let's say an individual buys 2 policies having premiums of 4 lakh and 2 lakh. In that situation, because he's breached the limit of 5 lakh with the 2 lakh policy, the second policy, what will be taxed will be the 2 lakh savings life insurance policy. Let's look at other example. If an individual buys 3 policies having premiums of 2 lakh, 2 lakh and a third one with 1 lakh, in that situation, he will be completely tax free because he's still under the limit of 5 lakh, 2 lakh, 2 lakh, 1 lakh. Since he's still under the limit, there won't be any tax in this situation. We've been speaking to a lot of industry players, and what they tell us is that the taxation will stop misuse of life insurance products by the rich as a tax-free savings instrument. Also, the Q4 numbers and in fact the March numbers will be very strong for life insurance companies because all these large ticket buys will happen as far as the policies are concerned, and that number could look strong. The second negative came from the new tax regime that has been sweetened, which sort of discourages buying of life insurance policies to take exemptions under the new tax regime.
Okay, all right, got that. And that's much needed clarity, Yash, so thank you for it. I think there was a lot of confusion yesterday in the afternoon, at least, around how this is going to work. In fact, Revenue Secretary Sanjay Malhotra made a crucial clarification regarding this matter as he was in conversation with Shireen. Take a look.
Is the 5 lakh rupee threshold for premium paid in 1 year or over the term of the policy? That's question number 1.
Yeah, so it's 1 year. So every year, you can contribute 5 lakh rupees towards one or more than one policy. And this is in addition to the 2.5 lakh rupees limit that you already have in ULIP. So overall, insurance basket, you can buy policies worth 7.5 lakh rupees year on every year you can pay that premium. So it's not over the life term. This limit is not over the lifetime of a policy, but this is an annual limit.
It's an annual limit. And, again on this aggregation aspect, is the threshold per policy or aggregate of all policies?
Aggregate of all policies.
Aggregate of all
together
policies.
For a year. For a year, but not over the term of the policy.
Okay, so aggregate of all policies for a year, not over the term of the policy. And will only proceeds from premium above 5 lakh rupees be taxed proportionately, or if a person crosses the threshold, 100% of the proceeds will be taxed?
That's right. I mean, if it crosses 5 lakh rupees, then that particular policy gets taxed.
Okay.
So he can always choose, to divide his policy and keep the premium, the 5 lakh premium, the policies with premium up to 5 lakh separate. If he wants to buy, still wants to buy a policy more than 5 lakh, that 1 lakh rupee policy can be different. So that way, he can avoid taxation on premiums, policies with premiums up to 5 lakh rupees.
Okay, that's an important clarification. Let's now find out what brokerages have to say. Surbhi is standing by what insurers and brokerages are saying about the development. Surbhi.
Hi, thanks for that. So insurance sector is impacted by the recent changes proposed in the budget yesterday. To give you some perspective, the non-par segment, which is going to be impacted, contributed 35 to 70% of the APE and VNB growth in the past 3 to 4 years. Now, a couple of managements have come out and put out a statement. ICICI Pru says that the non-unit linked policies with a yearly premium of over 5 lakhs is just 6% of their total APE for the 9-month period. And Max Fin has said that it is 9% of their individual APE for the 9-month period. Now, brokerages also have a view on this. Macquarie says that the HDFC Life APE will have a 10% impact. SBI Life APE will have a less than 1% impact. SBI Life and ICICI Pru Life look attractive to them at the current levels. Jeffrey says that the impact is higher for HDFC Life and Max Life, followed by SBI Life and ICICI Pru. Morgan Stanley also sees meaningful downside risks to FY24 APE and VNB growth forecasts. And CLSA has downgraded HDFC Life to a sell call from a buy rating, Max Financials to an underperform from buy, and SBI Life and ICICI Pru to an outperform rating from a buy rating.
All right, Surabhi, thanks a lot for taking us through that entire roundup of what brokerages are saying on the insurance space after this announcement did come through. But with that, let's shift focus and bring you some important earnings now. We are in the middle of the season, so let's get our first corporate conversation going. I'm going to invite the management of TCI Express on the show now. The company is in focus after their third quarter earnings, which actually look a little bit weak. So revenue growth has slowed down to around 10%, 9.5% to be precise. The margin has also contracted by around 60 bips to 15.3%. So to discuss the quarter gone by as well as the outlook, we're joined by Chandar Agarwal, the Managing Director of TCI Express, to take some questions. Chandar, morning, and thanks a lot for joining us. I'm Pavitra. First on your revenue growth itself, like I was mentioning, it has slowed to around 9.5%. So this is significantly lower than what we've seen you do in the past. Can you tell us what's really happening on that front? And with this, what do you expect the full year revenues to look like? Do you think you can still get to that 18-20% kind of band for the full year for FY23? Chandar, I think you're on mute.
I apologize. So the Q3 numbers were a surprise for everyone. And the way, we expected Diwali to take off and just spending to kind of unfold, that did not happen. And, it was quite surprising to even see that Diwali actually came at a time when it was a long weekend and there was pretty much no business happening at that point. So that really took a big effect on the cost side, because we were all ready for the the season, the Diwali season, and all of that. And in general, if you look at the year on year, we would still be doing about 17%. Yes, it would probably be a notch lower, only because of the economic situation. There's fundamentally nothing wrong in the company itself. It's just that, I have always said that we follow the trend of the economy, and however the economy is going, we would be going 2.5% of that. And that is still intact. There is no change in that.
You said 17%. That's the top line growth?
Yes, top line growth would be about 17%.
And this would be lower than the 18 to 20% that you had told us perhaps 3 months ago.
Yeah, because, even what I understand is that the economy is not in great guns.
Right.
And it will, next year, I mean, for sure, Indian economy will be, in a much better place than where it is today.
What about margins? Q3 margins have also significantly declined. What would be the margin outlook?
So this is just a temporary thing that happened. We always maintain about almost 18% plus. And even in during COVID time, we were doing about 18 to 20% margin, 18 to 19% margin. So that still remains intact, and I don't see a change in it at all. In fact, I still stand by the note that I'd given, that every year we will increase our margins by 1%, 1 basis points every year.
Chandar, just to understand the factors, I mean, you explained sort of the economic revival or perhaps a slight slowdown post the festive season. That's one. But I believe there's also been some increase in your ad expenses, marketing expenses. Could you just break that down? And maybe as a percentage of sales, to what extent is there an increase, if at all?
I mean, if you look at it, from a total cost point of view, it's the percentage is nothing. It's just that it stood out because we were advertising with CNBC, along with CNBC. So that was just a one-time thing that we had this year. In fact, our costs are still lower than our costs are still lower than 2019. So there isn't like a big spike. It's just that we assume that in the month of Diwali or the Diwali quarter, if we have a little bit of advertising, it would help in the overall business.
And so, I mean, obviously that's a one-off, but totally take your point. I just wanted to understand if that's sort of a change in trajectory and whether we should expect more of that in the quarters to come. So then let's dial back to the first point that you made, that business simply didn't take off as robustly as you perhaps had anticipated. You have just by a notch lowered your revenue guidance from 18 to 20% to 17%, as you were just speaking to Rima. So what are you expecting on headline growth in the quarters ahead? You're not expecting a bigger recovery in the Jan to March quarter. Why is that?
No, we will definitely have a decent recovery. It will probably, go back to, the top line levels what we had given. No change in that. We have to be always careful. We have to be careful as to, how everything unfolds. And unfortunately or fortunately, we get affected. That is, India gets affected by the global, situations quite rapidly, and that way, we have to be very cautious in our approach. We just cannot be very aggressive, and then at the end of the day, we're not.
Chandra, just a quick last point. I'm so sorry to come in over there, but we have to take that break. But just a last point, since you are cautious, is that going to impact your capex? Mangalam was telling us you had an outlay of around 99 crores, I think. That was incurred in 9 months. So what happens to capex now in the last quarter and the next year?
It's still the same. There is no change in that, and we are still debt free. So that is also something which is which is noteworthy. So everything is through internal accruals. So we're not facing any cash flow shortage or any cash flow problems of any sort.
500 crores of capex is still on track.
Yeah, for the next 5 years. Yeah.
All right, Chandra, we're going to leave it at that. But thank you very much for joining us and taking us through your outlook for TCI Express. The stock is at the low point of the day. We're almost 3 points lower right now. For the past 5 days, actually, there's been a near 13% cut on the stock. So do keep that in mind.
Valuations for TCI Express are also on the higher side. 35 times forward multiples.
Yeah, I was talking about the revenue slowing down. They've added a number of branches as well in the past 9 months. So, you would expect the revenue to pick up perhaps a little bit more, and he has revised it below the lower end of their guidance as well. But we will take a short break now. You don't go anywhere. On the other side, we're shifting focus from equities to the world of commodities. We'll tell you what's going on.
Hour, let's focus on commodities and find out what's going on in that side of the market. Manisha Gupta is joining in. Manisha, morning. You're talking about metals today?
I am, and what a strong run-up across the sector here. The decline in dollar index is one part of it, and the new demand coming in from EY is is another one. Markets have seen inventory concerns in any case, and is the reason that you have seen a strong build-up also on the back of Chinese demand, which seems to be coming back with a bang. So you have copper prices back at around 7-month highs. Aluminum also is trading at an 8-month highs right now. There is output cut continuing in many of those European smelters, and for aluminum as well, the global inventories are the lowest since 2002. And we have seen nearly 25% of a decline come in for the aluminum inventories in last 3 months itself. Nickel also is surged above $30,000 per ton here as well. Philippines could be adding export taxes in line with what Indonesia has done, and the market seems to be adding that premium into prices. Not just that, you have zinc prices also trading at a 5-month highs right now. Here as well, the LME zinc inventories have declined by 80% in last 12 months, and the markets are looking at reduced capacity from various producing countries like Netherlands, Germany and France. And not just the industrial metals, you have precious metals like gold and silver as well trading to 8 to 9 month highs. So everything under the bracket of metals seems to be doing quite well.
Manisha, it's totally fine. We're in budget season with all this tax talk. EVs can become EY. It's this whole 24-hour impact that's playing out on all of us. So absolutely fine. Thank you very much for that. Okay, let's take a quick break. We'll be back with more on the other side.
Welcome back. You're still tuned into Trading Hour. The market is, blinking red and green right now. So we've seen a near 140-point recovery from the lows. And the Nifty Bank also has recovered a fair bit, just around 0.2% in the red. We'll talk more about the market. But first up, we have Abhishek standing by to tell us what we can really expect from HDFC's earnings, which are expected later today. Abhishek?
Well, for HDFC Limited, Pavitra, expect the top line growth to be strong. So they've already given a business update which says that the loans assigned are up 19% YOY, but down about 2.8% sequentially. The dividend income was also down about 65% quarter on quarter, and the individual loans sold, now that's up more than 30% YOY and about 4% sequentially. The sale of investment has remained nil on a sequential basis also. So key things to watch is that the disbursements will be strong, especially in the individual segment. The AM growth as per Kotak Securities is estimated at 16% growth YOY and about 4% sequentially. sequentially. In this, the individual segment is expected to grow at 19% on a YOY basis. So net interest margin can expand on a sequential basis. Again, Kotak Securities is estimating a 5 basis point increase in net interest margin on a sequential basis. Credit cost to remain muted and asset quality largely to remain stable or improve on a sequential basis. So our polls suggest NII growth of 13.5% YOY and about 4.8% sequentially. We are working with a profit growth of 14.3% YOY, but a decline of more than 16% quarter on quarter. Back to you.
Thank you very much for that. Slip into a short break. When we return, we'll be joined with the management of JSPL to talk about their Q3 in the Adani Group stocks. Yesterday, Adani Enterprises stock was down 28%. And in a move which surprised many people, the Adani Group has decided to withdraw the mega 20,000 crore FPO. The board meet took place late last night. The group chairman, Gautam Adani, said the withdrawal is in the interest of the shareholders. Listen in to the complete statement coming in from Gautam Adani.
After a fully subscribed FPO, yesterday's decision of his withdrawal would have surprised many. But considering the volatility of the market seen yesterday, our board strongly felt that it would not have been morally correct to proceed with the FPO. For me, the interest of my investor is paramount and everything is secondary. Hence, to insulate the investors from potential losses, we have withdrawn the FPO.
All right, that is the word coming in from Gautam Adani on, why they withdrew the 20,000 crore rupee FPO. But we're also picking up from sources that the Reserve Bank of India has sought information from banks on their exposure to the Adani Group. What we understand now is that the information sought from banks is a part of standard operating procedure and SOP to address new developments that may have taken place. Now, sources are also saying that it is standard practice by the RBI to seek information whenever any developments take place, which are, regulated entities, and they do have exposures too. Sources are also adding that the RBI is seeking the information from banks as the central database may not have the latest information, especially linked to the pledged shares, as the CRILC updates some data weekly or monthly. So this is, just an update that we wanted to bring you on the banks, which now have to sort of provide what their exposure is to the Adani Group of stocks. With that, we are going to get into a short break now, but when we come back, that promised chat with the management of JSPL on the other side.
The market isn't really going anywhere, but we continue to put the spotlight on the Adani Group of stocks. They're all down. Let's just pull them up. Transmission, Total Gas, Green, most of them are down. The one that's the best of the lot today is Adani Ports. It's down just about 2%. Thereabouts. A lot of these stocks opened, slightly positive, and then the deep gashes started coming in immediately at around 9:15 or so. Let's see if we can go across to Nimesh, because he has been going through the latest notes that are coming in, a lot of the brokerage commentary on what the pledge situation is like. Remember, the Adani Group has constantly reiterated that there are no pledges in case of Ambuja and ACC. But right now, we're concentrating on the promoter pledges on the group companies, the Adani Group companies themselves. Nimesh, which brokerage are you looking at and what are they saying?
That's it, Surbhi. So Bernstein has put out a note after the company announced that they've withdrawn the FPO, and they've looked at both the angles, which is the bond of Adani Group and the pledge shares of the Adani promoter families. Now, I'll just look at the pledge positions of the promoter group, and they've classified across three categories. One is as of 31st of March 2020, which is a pre-COVID level. Then as of company's announcement per se, as of 31st of December 2022, and the fact that after yesterday's sharp fall, what could be the additional pledge required to gross up for the kind of market cap erosion which we've seen in the Adani Group stock. So let's start with the Adani Green first. If you look at the Adani Green, this is the bar, right? As of March 2020, the promoter pledge as a percentage of promoter holding was 13%. That fell to all the way down to just 4% as of December 2020. Now, after the fall we've seen in this group stocks, that is now inched up to 8%. That's the general calculation that Bernstein has put out after yesterday's fall. Similar is the case with is the case with Adani Power as well. They don't have the data of March 2020, but as of December 2022, the pledge position was 25%. After the sharp fall, that is now inched up to 39%. Look at transmission now. There has been a sharp fall in the promoter pledge of Adani Transmission in the last few years. So in March 2020, it was 54%. It fell all the way down to 7% in December 2022, and now it has inched up to 7%. That's the assumption that Bernstein is making. Similarly is the case with Adani Enterprise as well. And this is the most important of all the stocks because that's been in the news. The FPO got withdrawn. The promoter pledge at one point in time was 50% in March 2020. That has fallen down to just 3% in 2022 of December. And after the sharp fall that we've seen in the stock price, it has inched up to 5% is what Bernstein is expecting. Similarly is the case with Adani Port as well. It has fallen from 58% in March to 17% in December of 2022. And now after the big cut that we've seen in the stock price, it is inched back to 30%. So that's the promoter pledge that we're talking about. It has already fallen sharply from the March of 2020. But after the sharp fall in the stock prices, of course, post the December data is what they've officially disclosed to the exchanges. So from December, because of the sharp fall in the last 2 months, the pledge holding would have gone, or assuming that it can go up, because they'll have to either pay up or top up the shares, right? So that's the overall feedback as far as the pledge is concerned. And as you rightly pointed out, Surbhi, this is only for the other group stocks. The company has actually gone on record saying, as far as Ambuja and ACC is concerned, there is no pledge, so they don't need any further top-up of shares or top-up of money as well to protect those pledge shares. So as things stand, there is going to be a hike in the pledge shares of the promoters of Adani Group because of the sharp fall in stock prices in the last few days. Okay,
Nimish, that's very, very helpful. I think that chart really it's a good at-a-glance snapshot of where the promoter pledges right now stand. So. It's not so much in Adani Enterprises, and that's the big one to keep in mind. Adani Power is where the pledge, according to Bernstein, again, that's the important caveat. According to Bernstein, right now it is highest in Adani Power among the group companies, and the next highest is in Adani Ports. Again, this is Bernstein
and it's
data.
Quite seminal, the way they've brought it down over the last 2 years, right? Look at the chart between March 2020 and December 2022. So if it wasn't for the fall, the pledge of the Adani... Yes, go ahead.
The other way to read this is also the pledges gone down from March 2020 to 2021
because
there's been a big run up in all the stock prices, whether it's green, transmission, power, all have been a big move. Yeah. So hence that's been the reason why they've been able to cut down the promoter pledge as well in all the group companies.
Okay, thank you very much, Nimesh. That was very, very interesting. But now we've got a corporate conversation waiting by. GSPL reported a mixed set of Q3 earnings. Both revenue and profits were lower than anticipated, but the EBITDA and margins were ahead of expectation. The standalone EBITDA per ton improved on a year-on-year basis. The debt on the books has come down. To discuss the quarter gone by, we're now joined by the Managing Director, Bimlendra Jha, to take some questions for us. Mr. Jha, morning and thanks so much for joining in. This is Rima here. First, on the budget, there has been a big increase in the railway budget, 2.4 lakh crore, a record high. What percentage of your sales volumes comes from the railways, and is the EBITDA per ton for the railway work higher than the average?
Good morning, Rima. Thank you for getting me here. The budget thrust has not just been on railways. I think the budget thrust has been very much on the infrastructure and construction activities, around 10 lakh crores, which is far in excess of what happens in railways alone. Railways constitutes a smaller percentage of what we have as a portfolio of products for the entire infrastructure and construction market. We are almost entirely focused in that sector. And for us, this is a great budget. It is a continuation of the government policies to reinforce the infrastructure and construction space in the country, urbanization, the focus on railways and movement of material. I think all this very well for steel and cement companies, and particularly because these investments require the kind of products that we produce. We are very happy with the budget, and we look forward that India, in the first 9 months, where 12% was the increase in steel consumption in India, this trend is likely to continue with the help of this budget.
Hi, Mr. Jha. Thanks for joining us. This is Pavitra. So, like you said, there has been this big push that we've seen on the infra space. So, let's talk about what that could really mean for JSPL. Where do you see your sales volumes heading, because of this entire push that has come through? If you can tell us what you could end the year with, and what do you estimate FY24 looking like as well?
So, thanks, Pavitra. The JSPL, as I said, is focused on infrastructure and construction. So this budget, whatever is the already ongoing momentum in the country in this space, I think this is only going to carry on for the next financial year, which is good news for us. And what we see in terms of volumes is that our volume growth is currently restricted by our current production, which we are making new investments which will fructify next year, and then we will start gaining even more from there. But whatever are our current levels of output, we will remain at approximately similar numbers, even though we have created some new world records in production, and on the basis of it, that will be an incremental improvement that we can expect. Okay. As far as the financials are concerned, the financials have to be looked at in quarter-on-quarter improvement position basis, and we have more than 50% increase in EBITDA that you have already seen in quarter 3. We expect the momentum to continue.
Mr. Jha, can you elaborate on that when you say you're expecting the operational performance to continue to be higher? Let's just look at the EBITDA per ton level, 11,384. I mean, sequentially, that's a huge jump. So do you see higher realizations going forward? Because Nigel was explaining to us that the surge we've seen in Q3 is primarily on account of cost savings and all the internal tightening. It wasn't so much because of higher realizations. So if higher realizations also come in, then what could the picture look like?
So first of all, you should see that there were prices that were falling. And rock bottom prices, if you take Chinese HRC prices, they touched rock bottom of $520 in the month of November. And then December onwards, particularly towards the end of December, the prices started rising. And it was on the back of coking coal and iron ore prices that have risen. Because the demand is good, we are able to pass on these costs to the consumers. So realization has improved for JSP also because we have improved our product mix a bit. And of course, we have had tightening of the costs. So our costs went down quarter by about 9%, whereas there was a 1% decline in the net sales realization. So that is the benefit that you are seeing over there. As far as going forward is concerned, we are seeing that we are able to pass the cost increases in iron ore and coking coal prices in particular. And therefore, we don't have reasons to worry on that front. There may be a small improvement in margin going forward.
So can we look at, say, 12,000 a ton in Q4?
I never give forward-looking statements. You can try it again.
No, I won't. I'll pass it to Rima. I won't.
So I'm going to try on FY24 sales volumes then. Can you give us an indication with the thrust on the budget, on capex, on infrastructure, plus your production improving, what could that number look like for FY24 and FY23? Sales volume number.
So sales volume numbers, I already gave you an indication of what we are currently doing is around 2 million tons of production per quarter. We are very much going to remain in a similar ballpark number, just because our operational efficiencies are improving. A small marginal improvement gain might be there. But the sales are more dependent today on dispatches, where there are constraints on railway rakes being available, which are primarily focused on moving thermal coal around. And we are working with railways very closely in order to debottleneck that. Once that happens, I am sure that our sales volumes can go up, but otherwise it will remain at this level. Going forward in the next financial year, whereas our hot strip mill will come by the middle of the next year, there is substantial increase in our volumes will only happen when the blast furnace starts. And that will be only in the last quarter of the next financial year when we will start gaining those benefits. So our main thrust next year is going to be on the cost reduction coming from pellet plant commissioning as well as coal block commissioning.
All right, Mr. Jha, got that. Thank you very much for joining us today and taking out the time to speak with us on, where you see your outlook for JSPL. That is the management telling us that sales volumes will continue, because of the kind of thrust that we've seen on railways, on infrastructure, they can expect it to continue at a similar level. EBITDA per ton should also go up, although they are refraining from giving us, any kind of guidance on the numbers for that. We do have to take a short break now, but when we come back, we'll get a conversation going on the market that's really top of mind. So Tahir Badshah of Invesco Mutual Fund will join us.
Welcome back. Let's talk markets. Well, the budget has clearly given a big thrust to capex, but the question is also on consumption. Now, here CLSA has an interesting view. They're saying the tax slab change is unlikely to lead to large consumption change. The government, remember, has introduced new tax slabs under the new tax regime. Their analysis suggests that taxpayers are unlikely to benefit by shifting from the old tax regime to the new tax regime, and hence they do not think the budget will lead to a potential increase in savings due to the tax changes, leading to an incremental consumption boost. To take this discussion forward and the others and everything that's happening in the markets, we're now joined by Tahir Badshah of Invesco Mutual Fund. Tahir, where do you stand? Do you see the budget giving a big push to consumption? Is that a space to bet on?
Well, Rima, not quite. I mean, this is probably one area which is not been fully addressed, and maybe there were certain expectations in certain parts of the market that this lever was somewhat waning since the last 6 months, and we've seen this lever work out very well in the post-COVID period for nearly about 4 to 6 quarters, and of late we have seen a little bit of the receding of this catalyst as far as growth is concerned. So I think there were certain expectations, and more particularly, I think the rural part of the consumption basket, which is now been a bit of a slow, bit on a slow track for now, almost 1.5 years or more. So I think I would think that probably, at least from the budget's point of view, this is not being fully addressed. But we are happy about the fact that there is a continuation as far as the infrastructure and investment push is concerned. That is clearly the centerpiece of the budget.
Tahir, hi. The whole analysis yesterday was that it is a very, very sort of pro-growth budget, thanks to the large capex figures that we've heard and the promise of being on the fiscal glide path. But for the market here and now, what changes? I mean, do you see any immediate impact on any specific sector which you will start taking, let's say, a fresh look at because of the announcements yesterday?
Well, not quite. I mean, I think we were kind of positioned in that direction where the budget has led us to. So in a way, we've from the point of view of the domestic sectors and the domestic economy, we were reasonably positive as far as the investment cycle is concerned, and it's good to see that has been well supported during this budget in this budget, and I think that just offers that level of continuity to our thought process in that regard. But otherwise, I don't really think much changes. I mean, we have been on this mode that we are probably going to see a little bit of a weaker 2023 compared to 2022, and there's not really nothing significantly wrong with it. I mean, it's a cyclical phenomenon. At the end of the day, we saw a very significant surge in post-COVID consumption and everything else, and that's probably going to go through its bit of cyclical pressure. So I think that's where we are. It doesn't really change significantly the needle for us in terms of our sector allocations or our portfolio configurations.
All right, got that. Tahir, good morning. Thanks for joining us. This is Pavitra. I'll get back to the budget announcements in just a bit, but I have to ask you about, the entire Adani story that we've seen play out. Your initial reading on this, the FPO has been withdrawn, but how do you look at this, and do you think the bulk of the damage from a market standpoint is done?
Well, these are continuing risks. I mean, in the market, I mean, you typically have to deal with risks of this nature, and while we don't really have any exposure to the group at this stage, so I don't really think I'll be in a position to comment. But essentially, as far as any domino effects are concerned, I think it is there is a point of worry, but it is also we are taking comfort in the fact that the banks have significantly strengthened themselves in the course of the last 3-4 years, and in terms of disclosures too, it has been reasonably fine, and plus they are well provided in many ways. So I think the damage of it all will be a lot more contained this time around compared to the kind of episodes that we've had in the past.
Sorry, Tahir, just one more question, since you did mention the banks and we have been talking about perhaps the limited exposure to the Adani Group. Do you think that after a fact that these banks have corrected so much, these now look more attractive, and would you buy into banks now?
I think so. I mean, we some time back before this correction, I think the trade was becoming a little more consensus heavy as far as banking is concerned, and perhaps it was not fully taking cognizance of risk, not as much on the asset quality side, but perhaps on the side of margins. And I think this correction, therefore, at least takes away that part of the risk. It makes things a little more comfortable. Valuations have retreated to some extent, and maybe the market is a little more balanced now in terms of the view of the sector compared to having been very somewhat one-sided, I would say, in the last 6 months' time. So I think we'll have to keep differentiating between within the banking space and trying to line up our preferences. But I think some of this correction clearly will make entry opportunities available for some of our preferred banks.
Tahir, thank you very much for joining in. That's the view coming in from Invesco Mutual Fund. Believes the collateral damage from the Adani saga is going to be far more contained. For the markets, absolutely flat on the benchmark indices. The Nifty is blinking red and green. The Sensex is higher by close to about 0.25%. We're going to take your leave and trading off from the entire team. Thank you for watching, but stay tuned. On the other side of the break is a conversation with the management of Sun Pharma. Stay tuned.